right, well, welcome to our webinar today. It's a webinar on returning to work planning and loan forgiveness under the PPP program. We're going to start with the return to work planning, but it's probably a shorter portion of our time together today than the loan forgiveness portion. Again, for this webinar, we're partnering with Anderson, Coedy, and Asuma. And Craig Chilcote in particular will be leading us through all the loan information, things that you're interested in, things that you need to know in order to maximize your benefits on that program, and certainly answering any questions you might have. We're going to have questions at the end, so feel free to submit them using the Q&A box. If you have any trouble or you'd rather not use that, you can always email us. Our email address will be, and our phone numbers for that matter, will be at the end so that you have our contact information. So if you're in the Duluth area, you know it's a beautiful day. So we'll try to make this as swift as we can and get you the information you need. So to kind of start out the conversation today, my name is Justin Terch, for those of you who don't know me, and I'm with Terch & Associates. We're an HR consulting firm here in downtown Duluth. And we do all kinds of things. We work with HR compliance, we do executive searches, we outsource HR departments, performance management, do a lot of union work. And I'm going to let Craig kind of go over his company and the services that they perform when he jumps on to talk about the PPP loan forgiveness. But needless to say, we work very closely together. We're co-located right downtown, and we work with people all the way up from International Falls and the Iron Range down towards the Twin Cities. So if you have any questions or need anything, let us know. So the first topic is kind of about return to work. So the governor issued an executive order 2040 a week or so ago. And basically the executive order requires organizations to have a preparedness plan. And it's for any businesses that are, in particular, those that are non-critical sectors. So we're not talking about hospitals necessarily or public safety. We're talking about the office folks, manufacturing, as we move the restaurants, as we kind of roll back into normal everyday life. The order requires that employers have a written preparedness plan for COVID-19. They have a template out there that you can certainly customize. It's a great head start to get started on it. And it's you can get that right at the Department of Labor website. If you don't have it, just send me an email and we'll get you a copy of the template to get you started. So the plan has to be written. It has to be written, and it has to require work from home whenever possible. So the executive order is pretty clear that if you have a business, even if you're allowed to be open, but the employee can do their job from home, then they have to do their job from home. So that's an important distinction. I think some people don't realize that it doesn't allow people to go back to work who can still work from home. It's for people that can't work from home. It has to include policies that ensure sick people stay home. So examples of that, it would be, are you gonna have a questionnaire for employees to self-certify that they're, not having symptoms? Are you going to take temperatures? You have some flexibility right now. Normally those things aren't really allowed, but the EEOC has come out and said that in the situation we're in, there's a lot more flexibility with things like taking temperatures and asking employees about their symptoms. So as long as it's really narrowly construed to COVID-19, you can do that, and the executive order is asking you to identify in this preparedness document exactly how you will do that. The plan also needs to require social distancing. And you should think about how you can do that in your office or your workspace. So that might be things like how you're going to schedule people, or are you going to move office furniture around, or are you going to have some people work from home and others work in the office and then flip-flop. The executive order requires hygiene and source control procedures. So things like hand sanitizer, soap and water, Lysol and disinfectant of surfaces, You're going to want to explain what you're going to use, how often you're going to use it, who's going to do it. The company's senior management officer, typically the CEO or somebody else in a position of authority, needs to certify the document. So you got to sign it, and you need to disseminate it to each and every employee and post it at each work location. So if you just have one office, it's easy. You throw it up on the bulletin board. If you've got multiple locations, like maybe you're a group home company and you have a whole bunch of different locations, or you're a franchisee, you have a whole bunch of locations, you have to put one up in each location. The next part is you have to provide training. So it's not just enough to have the policy under the executive order, but you need to have some sort of a training protocol. Now, the governor didn't go into any detail about how elaborate the training needs to be. So I don't know that it needs to last any particular amount of time. I think for the most part, it may make a lot of sense for companies, obviously depending on the employee population, to just hold a webinar like this with your staff, or an electronic meeting with your staff before they return to work, that lays out what you're doing, what you expect the employee to do, and what your plan is, so that they have the information, and then it's kind of recorded and it's registered, and it makes a lot of sense so that there's not a whole lot of confusion about it. One thing to keep in mind is the OSHA general duty clause. So OSHA has been taking enforcement action in the last few weeks against companies who are not, in the opinion of OSHA, taking precautions seriously. So things like having soap, having hand or hand sanitizer, enforcing social distancing. Not only could it be an executive order problem, but OSHA is actively investigating those claims. So if your employees typically an employee files a claim with OSHA saying that you as an employer are not providing a safe work environment where they feel comfortable working, there's this catch-all called the general duty clause. Unlike other OSHA standards that are very specific, this just basically says that employers have a general duty of care to provide a safe workplace. And because it's so vague, they're able to cite a lot of things under there. So take your time to think about what you're going to do in your workplace, and if you're going to intentionally not do something, have a reasonable answer as to why, and put it in your plan so that it's clear why you made that analysis and the reasons for it. All right, so here's some best practices. The first one is to assign somebody responsible for the plan. And if you're a multi-location, assign somebody at each location. Have a site wellness coordinator, or whatever title you want to give them, as kind of an extra duty to really carry out that plan, to make sure that the soap is always full, that the hand dispensers for this hand sanitizer is always flush, that somebody is actively Lysoling surfaces like doorknobs and handles and communal areas. That just kind of is the coordinator and the person that really is tasked with ensuring the plan is carried out, and can help you as the leader identify issues as they come up. Now, you might be that person, but if you're a bigger organization, it makes a lot of sense to really appoint somebody at each property to really kind of be in charge of this. Consider re-engineering of your office, meaning, if you have a lot of workspaces close, try to find ways to separate them. Well, that might mean moving equipment or furniture around, and in some places that's really easy, and in other type of work, it's it's almost impossible. So you really have to use your best judgment. But just because it's hard doesn't mean you don't have to do it. So that's kind of what we're hearing from the Department of Labor and OSHA is hard is not an excuse to not do it. But there are cases where it literally is impossible. So just be real conscious of that, and make an extra effort to think about how can we rearrange the space to really improve safety. And maybe that means people who typically share an office don't share an office anymore. People who usually had their own office, in order to make sure that things are spaced apart far enough, maybe they're in a different space. So think about that. The other thing is think about staggering shifts. This is especially useful for office and clerical staff. Excuse me, I got a dry throat today. So if your office employees come in Monday through Friday, 8 to 5, it might make sense to have a group work, 8 to noon at the office and noon to 5 at home, and have the opposite group come in. So if you have normally 15 people in one space, then you might only have 7 or 8 in a space at a time. So if the work can get done at different times of the day, it might make a lot of sense to do that. If they can't get done at home, or if they need to get done at the office and they need all 8 hours, maybe you do a staggered 4 on, 4 off type of a system while this COVID is happening, in order to help with the social distancing. Number 3 is consider prohibiting visits at your property. It's probably an obvious one right now, but I think as we start to roll out the economy returning to work, and we get more permissive information from the government, it might make sense just to continue not allowing visitors on site, and to even consider prohibiting employees from doing site visits themselves for a while. One kind of benefit to the current situation is most people are pretty understanding about that right now. So it might make sense to kind of extend those practices for a little while. Number 4 is consider the need for PPE. Some people, some organizations might feel that actually having employees use gloves or masks might be important because social distancing isn't as practical. And in other workplaces, it's not needed. Maybe if you're in an office setting and everybody has their own office, and you have other protocols in place, you don't really feel like, and your team doesn't feel like they need to be wearing masks when they're by themselves in their office. But if you're not in that situation, think about how you're going to acquire that material, and how you're going to expect it to be used, how you're going to deal with employees if they choose to refuse to use it, and some of those questions. Obviously, there's a lot of information in the media about the lack of personal protective equipment. And while that's all true, you should certainly consider it as part of your plan, and especially if you can't accommodate social distancing. And then number 5 is be prepared for employees who are resistant. And I mean resistant in the sense that people who are telling you they don't want to come back to work. It's kind of an open secret now that a lot of folks are getting a significantly larger paycheck through unemployment than they are from their full-time work. And if that's the case, you will likely have some resistance. Before you make a decision, ask yourself, though, if the employee is entitled to leave under the FFCRA. That's we've done a couple other webinars on that. But they are enforcing that. We have a slide coming up on that topic. Is the employee covered under the Americans with Disabilities Act? There's some additional protections under the ADA that might allow additional leave as an accommodation. And then C, do you have work for the employee to actually do? So before you make a decision, kind of, and how you're going to handle the employee, kind of think through those 3 things. And ask yourself, and I guess FMLA as well, if that's if they have a traditional need for FMLA and they're covered, but kind of ask yourself through the leave entitlements so that you can decide what your position will be. If an employee does refuse to work and they're not entitled to some time off protection like the FFCRA, or they're not entitled to leave under the Americans with Disabilities Act or some other statute, you should report the refusal to the unemployment system. The Star Tribune reported a couple days that unemployment is saying that if fear alone is not an excuse, which is true under the statute, and that if there is work to do and you're not otherwise entitled to leave, and you are authorized to work and you refuse, the unemployment will be cut off. Now, I heard exactly the opposite answer from somebody from the state that was interviewed by the Duluth News Tribune. So I don't know that the people at unemployment necessarily know how they're handling this. My guess is that they're being particularly generous right now, but I would still put it on record with unemployment. I'd create a challenge if you're so inclined to say this employee is not entitled to protected leave. The employee is refusing to work. I've got work for the employee, and the stay-at-home order doesn't apply to this employee. And I'd put it on the record, and if they agree with you, fine. And if they don't agree with you, fine, but at least it's on record, because I'm guessing you'll deal with that later on as well when everything starts to wrap up. And then our last slide here is about the paid sick leave. This is the last thing I'm going to talk about before handing it over to Craig. So the Department of Labor is actively enforcing the FFCRA. There's been a number of employers whose employees have filed charges with the U.S. Department of Labor Wage and Hour Division, and they have come down. So far, what I've been reading is that the department is basically approaching the employer, issuing an order for the employer to pay the employee and to post some additional notices on the bulletin boards, reminding employees of their rights over and above the regular poster. And I haven't seen a ton of additional fines, fees, or surcharges, but I'm sure that there's going to be some levied soon. So they're not taking a super heavy hand, but they are actively enforcing it. And that is something you want to be particularly prepared for as you look at handling this, because I do think that employers are going to start to face some financial repercussions if they're not complying with that OSHA general duty clause and the FFCRA paid time off. So I'm just going to put you on a 5-second mute here, and I'm going to turn you over to Craig Chilcote.
Hello, everyone. I'm going to take over here from our portion from moving from HR to the PPP loan. So let's take a look here. Yeah, let's see if we can't get this to move forward here. Okay, so the PPP loan. So we've done a couple seminars on this, and our seminars were really more related to how do you get the loan. And you know, that really has been the guidance that came out was pretty limited at first. Everyone was applying, they ran out of money, they got refunded. And so now people started getting the loans a couple weeks ago. And so now the big question that everyone has is, how do I make sure that I get the loans forgiven? And so that is kind of what we're going to talk about today. So the Paycheck Protection Program loan authorized about 660 billion came out. They did one round of funding that ran out within 14 days. Now they're doing another round of funding that they're still taking applications on. And so right now, people are getting the funds. And so the big question is, what do you do? What are the rules behind that? And, you know, we've kind of determined how to get the loans. And so now what we want to figure out is, what do we need to do now that we have the loan? So the Paycheck Protection Loan, the calculation was 2.5 times the average monthly eligible amounts. And it is for up to 8 weeks of covered expenses forgiven by the SBA and paid to the lender plus interest. So you apply through approved lender, you have a 2-year term loan, no personal guarantee, and no prepayment penalties. And so as we kind of go through this, we're going to talk a little bit more about what's it going to take, what are the rules involved once you get the funds. So right now we have some limited existing guidance. We're waiting for the final guidance from the SBA, which is supposed to be coming about the 15th of this month. And the Treasury has a Q&A section that is continually updated, which is how we're starting to get some information trickled to us. So just as a caveat, this presentation isn't tax advice or a final interpretation on getting the PPP loan forgiven. What we're trying to do, we're waiting for the final guidance. And what we're looking at is this is our interpretation as of today on how we're going to do this. The loan forgiveness ultimately is going to be determined by your bank that you received the PPP loan from. And so they're going to have the final say once the guidance gets finalized. And so the basics of forgiveness. The debt forgiveness cannot exceed the loan. The debt forgiveness is excluded from income. 75% of your eligible costs for forgiveness need to be for payroll. Up to 25% of your eligible costs can be used for rent, mortgage, interest, and utilities. Forgiveness will be reduced for any employee, full-time employee cuts, or pay reductions based upon a formula. And relief is available if employees are rehired to the same census level and or pay increased to the prior to adjustments by June 30th of 2020. So we know what the basics are. We know that it can't exceed the loan. I have a little asterisk by debt forgiveness is excluded from income, because I think the one thing to keep in mind is that they've stated that the loan itself is not forgivable. I mean, the loan itself is not taxable, but the big question is, what about the expenses that you use that you use the loan to pay for? Are those going to be deductible? So right now, it looks like they are not going to be deductible. So you don't get to, in theory, double dip. So you're paying expenses with a loan that is forgiven. And then these expenses are not going to be deductible, but we're waiting. This is one of the areas that we are waiting for guidance on, just because we don't have that information as of yet. So the mechanics of the PPP loan forgiveness. So the 8-week clock starts ticking on the date the proceeds are deposited into your account. So what we're recommending is put the proceeds in a separate account and use that account to reimburse your business for the eligible costs. So in order to make sure that you want to have a very clear path on what you used those funds for. And by putting it in a separate account, you're really keeping it out of your operating account. And what you're doing is you're going to be very clear over this 8-week period on exactly what those loan proceeds were spent on. So when we're looking at this, how to handle this loan, we want to think cash basis. So from the date the money gets deposited, we know that we need to track carefully what we're going to spend the money on. So we can spend the money on payroll costs, which includes employer portion of the employee health insurance, retirement plan, employer match, state unemployment taxes, federal Medicare and Social Security employer taxes are not included. Other eligible expenses, which are the non-payroll expenses, are rent, mortgage, interest, and utilities. So these are the core expenses. You know, there's a lot of questions. Well, what about cell phones for the employees? That's a utility. Well, not necessarily. So we're trying to interpret this as literally as possible. And we're just saying payroll costs, health insurance, retirement plans, unemployment, rent, mortgage interest, or utility or utilities. So those are how we're going to interpret this. So then what we want to do is we really are looking at this like a three-step process. Number one is we want to create a pool of forgivable dollars. Number one. Number two, we want to maintain the head count. Oh, now it's working. Let's go back. We want to maintain the head count. And number three, we want to maintain payroll pay levels. So these are kind of the three steps that we want to keep in mind. So the mechanics of forgiveness. Number one, let's create our pool of dollars. For an 8-week period, starting at the date of funding, you're going to need to track spending on the following items: payroll expenses and non-payroll expenses. Payroll expenses, which is back to that prior slide. This is your payroll. This is your health insurance. This is your retirement funds. And this is your state unemployment tax. Non-payroll, rent, utilities, interest on mortgage debt. Those are the ones that you can spend the money on. Now we have a very important distinction to make on the 75-25% split. So in the documentation, it states that up to 25% of the loan forgiveness amount can be used for non-payroll purposes. It does not say 25% of the loan proceeds. So this is going to be important to understand. So I've sat through a whole bunch of webinars over the last couple of weeks, and I've seen it several ways. But consistently, it seems that the intention of this loan was to pay payroll. So payroll is going to be the basis for the loan forgiveness. So as an example, you received a PPP loan of $300,000. In the 8-week period, you had payroll costs of $150,000 and rent of $75,000. Your $150,000 is a forgivable expense. The amount of your loan that would be forgivable, assuming that your headcount is the same and your pay rate is the same, is $150,000 divided by 75% to get to 100% of $200,000. So that gives you $50,000 available as forgivable rent, even though your rent you may have spent $75,000 on rent, only $50,000. So the PPP loan creates your baseline and helps you back into the forgivable piece. And so when the calculation was done, that's why it was 2.5 times your average payroll. So that what they're trying to do is, as long as most of what you're spending is on payroll, then you're going to have it mostly forgiven. But the loan forgiveness really starts with payroll, what you're spending on payroll over this 8-week period. Okay, the mechanics of forgiveness: maintain your head count. So again, waiting for final guidance. But right now it looks like an FTE is 30 hours a week plus. So that is how you're going to do your full-time equivalent calculation. And what has to happen is you have to maintain your head count. Now you have a choice on the period of time that you're doing your comparison. So you're going to take a look at your baseline full-time equivalent you're going to either pick your baseline as the period from 2/15 of 19 through 6/30 of 19, or you're going to pick your baseline from 1/1 of 20 through 2/29 of 20. So those are your choices, and you can pick the best one. You can pick the one that is the most advantageous. So compare the baseline headcount to the average headcount during the 8-week period and calculate the percentage of FTEs retained. If your headcount falls below 100%, it's not the end of the world. You can correct that by getting to the same headcount as of 6/30 of 2020. So over that 8-week period, if you couldn't get everyone back, if you were closed and you just couldn't get the number of employees in that you needed to, it's not the end of the world. As long as you can get your staffing back up as of 6/30 of 2020. Now here's the unknown. What if you are one person short and on 6/29 you hire someone? Does that count? Right now it looks like it does. Now the thing to remember is there needs to be a business purpose. So people have called and asked, well, what if I'm short and I just hire my spouse to do it? To do what is the big question. So you're going to need a business purpose for what they're going to be doing for you as an employee. But as long as you have a business purpose, I think you're going to be, until the final guidance comes out. Right now it looks like you are going to, as of 6/30 of 2020, you need to be at the full-time equivalents compared to your baseline. And if you make it, your loan should be forgivable, that portion that was calculated. Now, the other thing is it doesn't have to be the same employees. You don't have to hire everyone back, the same people back, as long as you have the same headcount. That's the key. Okay, here's the next question I get. Justin touched upon this. My employees won't come back due to making more on unemployment. Am I in trouble? So according to some guidance that came out this weekend, which was on 4/4 of 20, earlier in the seminar, I talked about the PPP Q&A, which is on the Treasury site. Now on the Treasury site, it shows, it gives you frequently asked questions. And this was one that came out, it was updated over the weekend, one of the two that updated over the weekend. I'll talk about the second one as well. So according to the guidance put out on 4/4, if your employee, you made them a legitimate offer in writing, and there's no reason for them not to come back, you have the work for them, and you made an offer to them to come back, that is going to be your evidence. If they reject that offer, you're going to document it. And according to the guidance that came out, that is not going to be held against you. So for right now, that's what it looks like with the newest guidance. And so what I would say is, when you are looking to get your head count back up, you're going to want to make sure that you are making the offers to come back to work in writing. And you're going to want to make sure that you have that all documented, because that is the head count is one of the most important things. Okay, maintain payroll pay levels. The third part is you need to make sure that your pay levels by June 30th are going to be the same. Now, this is a slightly different calculation. Your FTE calculation is a broad calculation where you're looking at payroll as a whole, total number of people. But your pay levels is on an individual level. There's an individual calculation. And for anyone who's making, anyone whose pay has been reduced by more than 25%, you have to start paying those dollars back, which would mean that your loan there's going to be less of your loan to be forgiven. There's a calculation on this. I've seen multiple calculations, and I'm waiting for the final guidance on this one to really lay it all out, because I've seen a couple different versions of this. The thing to keep in mind, though, is I think what we're seeing with a lot of our clients is, for the most part, people aren't necessarily, they're either laid off or they're not. They're not getting their pay reduced by 25 or 50%. So they're either working or they're not. And if they are working, the pay is staying the same. But like the head count, you can fix this by making sure the pay levels get back to the prior levels by June 30th of 2020. Again, we need to make sure that the pay levels are the same. If they are down and the calculation gets done, it could reduce your forgiveness. All right, let's do a quick sample calculation. Look at my notes here. All right, so PPP loan, $650,000 you receive. Payroll expense over the 8-week period are $450,000. Your non-payroll expenses over the 8-week period are rent and utilities of $150 of rent, utilities of $20. Your full-time equivalent from 2/15 of 19 through 6/30 of 19 is $20. The full-time equivalent from 1/1 of 20 through 2/29 of 20 is $18. So those are your two baselines. You can choose the one that gives you the best advantage. So your FTE during the 8-week period turns out to be 15 employees. Well, first of all, we want to say, okay, how much of this loan can be forgiven? Total expenses available for forgiveness, $600,000, which is the $450,000, which is the total payroll expenses divided by 0.75. 600 out of your 650 is available for forgiveness. Now, the question is, what if I'm close on payroll, but I'm going to be a little bit short? Can I give bonuses? The answer that we've seen is yes, you can give bonuses. But remember, there's a limitation on wages and salaries. Anyone is limited, employees or owners, to $100,000 a year. So if you're giving a bonus to increase your payroll and it's getting above the prorated $100,000, it doesn't benefit you. But as far as frontline employees or people who are not making 100, if you want to give them a bonus, that would be included. That's okay. So in this case, total expenses available for non-payroll would be $150,000, which is $600,000, which is the total available for forgiveness minus what you paid in payroll, or minus the 75% of $450. So you have $150 available. So now we've calculated our potential forgiveness amount, which would be the step one, is calculating our pool of dollars is $600,000. Then we're going to look for reductions. So we have 15 current full-time equivalents. We had 18 in our most beneficial period. So we are going to reduce that 600,000 by 15 divided by 18. So you're going to get about 83%. So you're going to get 500,000 forgiven. So 500,000 forgiven. You're still going to have a loan of 650,000. But let's say in our example, you got to your full-time equivalent as of the end of the year. As of the end of June 30th. So you got up to 18 by June 30th. Then you're going to be 18 over 18. That is 100%. And so you're going to get the full 600,000. But so this is the headcount calculation. We have the other calculation, which we discussed, which was related to the pay. So that calculation is you're gonna come up with a reduction in the forgiveness as well. In this case, we're gonna assume the pay stayed the same. And so we don't have to worry about that portion of the reduction. Okay. So now one of the big questions always is, what happens if I don't have loan forgiveness? You know, a lot of people are calling saying, I'm really concerned about this. I want to make sure that I get it all forgiven. Which is really where I get back to put it in a separate account and use that account to transfer the money to reimburse yourself for the expenses. By doing that, you're kind of protecting yourself. Because if you just put this whole pool of dollars into your checking account, we don't want it to get all intermingled. If you keep it in a separate account, what it's going to do for you is you're going to reimburse for these expenses, your gross payroll, the expenses that we've discussed. And then when you get to the end of that 8-week period, now you have some options. So the other thing you can do is once you calculate what's going to be forgiven, you can pay back the remaining balance. Pay it back. There's no prepayment penalties. The other thing is it's a low interest rate. It's a 1% interest rate. You have a 6-month, you don't have to make payments for 6 months. So effectively, you're going to pay your loan over an 18-month period. Now, here is the one area that I'm looking for additional guidance on. I've seen this both ways. If you have a $650,000 loan and you get $600,000 of it forgiven, you have $50,000 left. So you don't have to be making payments on that $50,000 for 6 months. My big question is in your original loan documents, you're going to see an amortization of paying your $650,000 over a period of 18 months in your loan documents, which is what, $30,000 or $40,000 a month. Now, the question that I have is once it gets forgiven, is your bank going to re-amortize the remaining balance? So in the case of the example, $650,000, $600,000 was forgiven, you have $50,000 left over. You turn in your expenses to the bank, you turn in all the evidence of what you spent the money on with the calculations. Your bank is going to review it, they have 60 days to decide. And once the forgiveness goes through, the question is, are they going to re-amortize that loan? Now, instead of a $650,000 loan, you have a $50,000 loan. That is, I haven't seen that guidance. So if they don't re-amortize it, you're going to have 1 or 2 very large payments, and then the loan is going to be taken care of. If they do re-amortize it, then you're going to pay that $50,000 over the next 18 months. I haven't seen specific guidance on that yet. It could be out. I would imagine that's something that's going to show up pretty soon. Okay. Now, here is something else that came out this weekend. And this is the one that made a lot of people kind of nervous. So when these loans came out, there wasn't a ton of guidance on how to qualify for it. In fact, the application was pretty simple, pretty basic. It asked you a handful of questions. And one of the questions it asked you is, do you feel that there could be an economic effect due to the COVID? That was the question. Are you concerned about economic certainty? And in fact, you certify in the middle of this paragraph, current economic unsecurity makes this loan request necessary to support the ongoing operations of the applicant. The big question is, what does this mean? So before the CARES Act and before this PPP loan, you had these SBA loans, a 7A loan, were available. One of the reasons why these were available is for businesses that couldn't get a loan somewhere else. So you had to prove or show that you need an SBA loan because you can't get money from somewhere else. That was part of the requirement of getting an SBA loan. So when you're doing this loan, you had to be careful on having some evidence that you couldn't necessarily do it. You couldn't get proceeds anywhere else. Well, one of the things with this PPP loan is that you now didn't have to prove you couldn't get a loan from somewhere else. So you didn't have to prove it. So then it gets back to, okay, I applied for this loan. Maybe I didn't qualify for it. Well, the guidance had been coming out sporadically. A lot of people didn't know they applied. You saw a lot of public companies that applied that technically qualified. They were either a franchise, they were publicly traded, but the way they were designed, their sites had less than 500 employees, and it was all over the news that these big companies ended up getting a bunch of this money that was really meant for small businesses. So one of the criticisms on this was, okay, why should they get the loan when they have the access to other funds? Even though, remember, that was actually taken out of this program. So this question came out this weekend and made people concerned that, because they said in the rules, if you received the funds and you shouldn't have, if you didn't qualify for them, you have until May 7th to pay it back without any penalty. Well, so now people are thinking, well, what happens if I miss this May 7th deadline? Maybe I shouldn't get it. So we're looking at this and taking this literally and saying, do you have a concern for economic trouble? Do you have economic uncertainty with this? And the people that I have been working with who have applied all had economic certainty, whether it's the restaurants that had to close down, whether it's the businesses that customers are struggling and their pay is dropping, whether it's additional expenses for maintaining the business. I think that there is definitely economic uncertainty out there. And there is nothing that says you have to prove you couldn't get money from somewhere else at this point. So, I think at this point, I think doing any sort of documentation on what your economic uncertainty is going to be the important piece of this. Because I think that you can show what this is, what your concerns were with your business, whether it's, I didn't have enough line of credit. I needed to, my sales were dropping. So I think economic uncertainty is part of this program here. So I just don't see that. I think it's certainly an area that there's going to be some guidance on. I think there's certainly an area that we're going to have to do some sort of documentation on what the reasoning behind that is. But as of right now, with the guidance that we have in place and what this says, you're going to look at what your uncertainties are and show that. And I don't think that it is going to be a huge burden at this point. So, a a big thing that we're all waiting on is the guidance that's going to come out on May 15th. You know, that's really going to help us, because ultimately the banks are the ones that are going to do the loan forgiveness. And so those are the ones that we're really waiting for that guidance, and we're going to work with the banks to put together the information in the format that the SBA wants it, as well as the banks want it. So for right now, this is kind of what we're doing. We're taking everything conservative and literal in what the rules we've read and everything to make sure that we can maximize the forgiveness of these loans. One of the things I see is a couple questions here. I'm just taking a look here. So there are some questions regarding to the loan application didn't differentiate between full-time employees and part-time employees. So all employees were reported. And then when factoring the headcount, only consider full-time employees. You noted there were only 30 hours plus weeks. So what I would do is, I think how you applied for the loan is one thing, but I think the forgiveness piece is the other. So I think you're gonna, on the forgiveness side, you're gonna compare apples to apples, and you're just gonna do a calculation on your employees as a whole for what are your full-time equivalents, and also what your full-time equivalents are for the 8-week period. This person who asked a question knows me. You can always email me, and we can go through that a little more specifically. And I think the other one was, are we going to share the slide deck? And yes, we are going to share the slide deck on this presentation as well. So I didn't see a ton of questions. This was, you know, this is a topic that the forgiveness piece is going to be something ongoing. My plan is to continue to update this, and we're going to do another seminar once we get some further guidance. So keep an eye out for an email from us in the next couple weeks. And I know Justin's going to have some further updates as well. So thank you for attending today. I appreciate it. And we are going to, this is being recorded, as well as we're going to share a slide deck after. And
we'll put up the next slide here so that you have our email address and our contact information.
Yep. Hold on. We're just doing it right now.
I think if you just click right there.
All right. So this is our contact information. Check our emails are on the website. You can give us a call. Thank you very much. I appreciate the time that you took to visit with us today, and you'll be seeing a slide deck shortly. Thank you.